The S&P 500 just had its biggest single-day sell-off we've seen since the Liberation Day tariff shockwave back in April, and the trigger will sound familiar: another major tariff announcement. It came after President Trump detailed plans for additional 100% tariff on all Chinese import. The tech-heavy Nasdaq was hit particularly hard by the news, dropping over 4% as investors worried about the exposure of crucial supply chains for semiconductors and electric vehicles. The last time the market reacted to major tariff news in April, it triggered a major sell-off and a 12% market decline. But that fear was short-lived, and the market came roaring back with a huge rally soon after. The question now is whether this time is also a temporary blip before a major rally or a signal of more pain to come. According to Goldman Sachs, US consumers are at 2/3 of the costs of tariffs through higher prices on everyday goods. They estimate that businesses and foreign exporters would bear the rest. This directly fuels fears of inflation, which could complicate the Federal Reserve's plans for lowering interest rates, which have been fueling the market higher. Here we can see the US Core Consumer Price Index, which excludes volatile prices of food and energy. This is what the Fed focuses on. You can see that it's ticked up since March, from 1.8% to 2.5%. That's a concerning trend, and above the Fed's target of 2%. But if we add on the US Producer Price Index, or PPI, we see a different picture. This tracks the wholesale prices that producers pay to make goods. It's a leading indicator because they pass these prices on to consumers. You can see it peaked here in March 2022, a full 6 months before the Core Consumer Price Index peaked. And we had another recent PPI peak in January, but the PPI has actually fallen since then. So we could be seeing the delayed onset of those higher costs being passed on to consumers before potentially falling again. Time will tell. But if inflation does continue to rise, we could see the Fed reverse course on lowering rates, and to battle resurgent inflation, they could hold or even raise rates again, with potentially far-reaching impacts on economic growth.